All right, good afternoon, ladies and gentlemen. I'd like to call this hearing to order and acknowledge that we're in Treaty 1 territory and the home and the traditional lands of the Ojibwe, the Cree, Dakota people, and the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Ron Merritt. I'll be your chairperson this afternoon, introducing the panel members via Zoom. Linda McFadden and Val Warhan. Our recording secretary is Phoebe Graywood, and our assessor from the city of Winnipeg is Attire Rehan. To the Zoom, I don't think I have to read the Zoom, but I will. To the Zoom participants at the hearing, please note that you will be placed in the waiting room until the property is called upon. Then it'll be your turn to be admitted to the meeting. Kindly follow along the City of Winnipeg revision for YouTube channels for the hearing process. Once the host admits you to the hearing, please close or mute your YouTube player. It will then be permitted to speak in respect to your property. Once the hearing has been concluded, you may leave the meeting. This afternoon, we'll be hearing application for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested is described in each application, and we'll limit the discussions to those matters. The statements that are made at this hearing are sworn testimony, and anybody speaking in these matters must be sworn in. Please be advised that assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by City Council and is independent of it, along with the city administration. We make our decisions based on the evidence provided at this hearing and issue a written order to be mailed to all parties as soon as possible. Please note the board decision in respect to application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or the Court of King's Bench if the matter pertains to application from exemption from taxations. Should you wish to appeal, information on how to do so will be included in the board's order. In respect to the hearing this afternoon, we'll confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony, followed by questions that the applicant may have, and then it'll be the applicant's testimony, followed by questions. Each party will have the opportunity to summarize if they wish. Once all evidence about the application has been brought forward, the applicant may leave. The process will repeat for each item on the docket this afternoon. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live stream recorded and will be part of the public record. We'll be hearing items 3, 4, 5, 6, 7, and 8 on the docket. So, Ms. Phoebe Graywood, can you please affirm the assessor and the applicant's testimony?
Mr. Rehan, can I get you to state your full name?
Arthur Rehan.
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. Dupont, please state your full name.
Henry Dupont.
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you.
All right. All right, we'll start with the first item that we have on the docket. Mr. Dupont, you're representing all these properties that are on the docket this afternoon?
Yes, I am.
Okay. So we'll first deal with 261 Goulet Street. Mr. Assessor, whenever you're ready, you can take us through this evidence and your presentation.
Okay. Thank you, Mr. Chair. First of all, hello to everyone. So the first property on the docket is 261 Goulet Street. File number is 242730. The roll number is 0607551000. Address again, 261 Goulet Street. The 2025 assessment is at 17,067,000. Its in classification is 2-0, which is residential 2, and it is taxable. It has one building and 6 stories, actual built year of 1964, the effective year built of 1964 to 1984. It has 105 suites with 51 outdoor parking spots. Moving on to page 2. Oh, well, so now just moving on ahead with my presentation, I do have a certain recommendation to make to the applicant. Just for the board to know, there's 2 properties on the docket, 261 Goulet and 291, which are kind of a very identical properties.
Yes.
And so the 291 Goulet cap rate is 5.65, and for this one, it is at 5.45. So I would like to revise the cap rate on this one to 5.65 to make it similar to 291 Goulet. And
Okay.
keep everything else same, the income expense, the NOI. So I like to make a recommendation of 16,463,000 based on 5.65% cap rate.
16 million for
63,000.
Can you repeat that, please?
Sure. 16,463,000 rounded off.
Mr. DuPont, are you in agreement?
No, not accepted.
All right. Mr. Assessor, you may continue with your presentation, and the applicant has not accepted the recommendation, so just continue with your presentation.
Okay, perfect. Thank you so much. So yeah, page 2 has a request for income information, which shows that the applicant has been compliant. There is no subject sale history on a record. On 3rd page, we have income value summary, which shows there are 13 bachelor units, 60 1-bedroom, 30 2-bedrooms, and 2 3-bedroom units, totaling up to 105 units. The average monthly rent per unit is coming up at 1,339.77. Here is some breakdown of the growth potential rent, which is coming up at 1,688,110. The vacancy rate we're using is 2.6%. This is the model vacancy rate. The EGI effective gross income is coming at 1,644,219. Expense rate of 43.43%. The NOI is calculated as 930,135. As I said, I've already revised the cap rate at 5.65 for the property. So the value that I am using is 16,463,000.
I thank you, sir.
And
Mr.
sorry.
DuPont, questions of the assessor?
Yes, your page 4.
Yeah.
Your comparables. When you get 1364 rent for 50 Alpine, what figure are you taking? You're taking the total rent on the questionnaires before discounts, or is it including parking and laundry, or where'd you get that figure?
So the average monthly rent per unit on the comparable sheet is basically what is actually reported by each company every year to the city. So that is the rent we use for those ones.
Yeah, the question is, are you reporting the potential rent, the rent actually received?
It's actually received, not the potential one.
So you divide by 186, so the so the 50 Alpine it's received does include the parking.
I'm not sure if it does include the parking at this time.
50 Alpine, it's says 1970, so it was actually built in 1970.
Yeah.
Whereas the subject was built 1964.
Mhm.
You gave it an effective age, 1984. But you would agree the subject is an older apartment block, and it looks much older than 50 Alpine, which looks like a modern high rise.
Yeah, I mean, the subject property has had major renovations done to the property, starting back at 2015. Now the effective age is kind of representative of the work done. Now I believe because the similar property was done, same renovations, 291 Goulet, it only has a 10-year effective age. This one has 20 years effective age. I have no kind of statements or reasons for why there is a discrepancy between those effective ages. I couldn't find any reason. But what I would like to say is the subject property has major renovations to the suites, to the balcony, to the exterior of the buildings in the past 10 years.
The 50 Alpine, the total gross floor area is 1432 square feet per suite, because we have the appeal on it, so we know.
Okay.
And you report 1088. Would you agree that you're excluding the basement for 50 Alpine?
I'm not sure exactly because I haven't had a detailed look on the property regarding the gross floor area. It is what the model has just brought up in terms of comparisons.
And the subject, you have a very round figure of 1,000. Now, if you take the square footage that you have, 114,180 divided by 105 suites, it comes to 1,088. Do you know where you get your 1,000?
So the gross floor area on here is 105,025 for the subject. And it's divided by 105. So I think it's just rounding off to 1,000.
Oh, okay. Yeah. Okay. So I think my report is wrong. Yeah. Okay. That's good. But 50 Alpine, you don't know whether it includes the parkade or not.
Yeah, at this time, I have no knowledge of that.
So still on page 4. So the other three comparables, they're 1255, 1263, and 1240, and your subject is 1339. So you're much lower for the three comparables than the subject.
Yeah.
Yes?
I mean, I would say that is pretty much, that's due to the effective age on the building. That's what the model has come up with the average monthly rent.
So would you agree today to use the actual rents of the subject instead of your model rents?
Yeah, if I had to kind of review that, I can, using the actual income would be the better option. I agree to that.
Okay, that's all the questions I have.
I thank you. Ms. McFadden, questions of the assessor?
No, I think my question has been asked and answered. Thanks, Ron.
All right, I thank you. Ms. Warhan?
None, thank you.
Okay. I just have a couple. Like you haven't inspected the properties at all, both that 261, and 291? No?
No, I have not personally went and inspected those properties.
Yeah.
So.
And I think in your presentation, there's a permit in there, but I don't think there's any dollar value. Is there not? In here for this one?
So on page 8, there is a permit.
Yeah.
It has the dollar value of 13944335.
Okay.
And then if you see, there are some pictures following up on that.
Yeah.
So yeah, I mean, this basically shows that there's in the last 10 years, going back to 2015, there has been major renovations to the property.
Okay. And this property has got a pool at the back, does it not?
It does. It does an outdoor pool.
Little unusual. The same as the next property too, but they're sister buildings, are they not?
There are, yes.
Yeah.
That's why I was kind of in terms of agreement with the cap rate for those views.
Mm-hmm. Okay. All right. I have no further questions. So, Mr. DuPont, your presentation.
Could I
Floor is yours.
redirect on that building permit on page 8?
Absolutely.
Description above, it says structural repairs regarding the balconies, plaza deck repairs, so that it's more of a structural than any interior alterations to the suite. You would agree with that?
I mean, usually when building owners or even the the owners, they take out permits, it's not exactly what is written on the permit that they do. Sometimes there is additional work done, and the reason for us to kind of, use that effective age is basically off the pictures of the property. The pictures of the property shows that the suites does not look like built in 1970s or 1964. It has new cabinets, new flooring, new countertops. So, and this was also like, if I have to go back to, just give me a second here. I did some in history on that. So, yeah, I mean, in 2016, there were rental ads showing with new balconies, glass railings, renovation of exterior. In 2018, that's when they started doing the suites of the building. They renovated new kitchen, bathrooms, and flooring. Yeah, although there were no permits, but the work was done.
It's all questions I have.
Well, thank you. Your presentation for this property, Mr. Dupont? Floor is yours.
Okay, go to page 12, please. So on top, right above the line where I have gross floor area, 114,000, that's an error. The assessor said it was 105, I believe, in his report. Yeah, 105,025. We have the suite size on top there. The bachelors are 399 square feet, 1 bedroom 585, 2 bedroom 760, and 2 bedrooms only 2, but they're relatively large. So they have 51 outdoor parking, which is only 49%. So I dispute the effective year built. I'm using 1974. Same as sister building at 291 Goulet. So they're both sister buildings. And for some reason, they put 1974 effective age for 291 and 1984 for this property. So line 3, the actual rents received, 1,518, and that's what we use, is 1206 per suite. And for a building built 1964, this is relatively high. So it's totally due to the upkeep that the owner have been doing on this. So these are site specific. So the assessor's rent is $1340, which is much higher than what they're actually obtaining. And the assessor agreed that he would use that, even though it's not part of his verbal recommendation. So we stabilized at 2.9% vacancy, which is the actual, and the vacancy is relatively high for the prior 2 years, 5.5, 5.9. We had the bad debt that it has. The total expense line 31, where 708,000 and the assessors have some 14, so dollar-wise, we're pretty much the same as the assessor. We have slightly less expense ratio, mainly because we have lower rent. The repair and maintenance are stabilized on the next page 13. So 2018, there was a lot of the items that we show in red that we disallowed those items. So they had some appliance replacement, high-end painting, electrical and plumbing, as well as general building. It was relatively high and extraordinary repairs. So we excluded that from the averages. We also excluded the plumbing in 2021. Those items are shown in red. And so then under general building, we allowed 50% of what they had. And then under the notes in red, it shows what we've allowed differently than the averages. So for appliance, we went at The average, excluding the high 2018 times 83%, because we're going with the maximum, which is 225. So we stabilize at the maximum. Same as painting, we stabilize at the maximum. We take the average, excluding 2018 times 89%, immediately to get to the maximum. So then when we go down, we stabilize at 2273 per suite, and the bottom line, the R&M per suite, excluding capex and waste and snow, is shown there for each of the years. Most of them are above what we're stabilizing, 2273, because mainly we're excluding a lot of items over the time. So back to the page 12. So the expenses are stabilized in a relatively normal fashion. It shows what we're doing, average or actuals, and the stabilized repair maintenance. So that the total expenses, it was less than the assessor. So our NOI line 33, we're 831 versus the assessor 930. So we're 100,000 less, mainly because our rents are line 13, 120,000 less. So apply the cap rate 5.65, it comes 14,715,000. And that would be my report, except we can go to the photos, page 16. The photo is the first photo of the kitchen. And it shows that they have relatively new appliances and new flooring. Then we have the square footages that they have floor layouts on their website. So the suites are relatively small, which we've shown in the top right of our income approach. And there's more photos on page 20th. So the vinyl plank flooring, relatively modern kitchen. And show a small pool in the back. And the financials. So that would be my report.
Thank you, sir. Mr. Rehan, questions of Mr. DuPont?
Yes, Mr. Chair, just a few questions here. So Mr. DuPont, now I see that there are the RM repair and maintenance expense you're using is 238,619, which is coming up at 2,273 per suite, if I'm correct. Is that right?
Yes.
So, I mean, would you agree this is like a very high per suite R&M based on the renovations done to the property in the last 10 years?
No, I don't think we can say they've done renovations over the years. What they're doing is they're updating the suites on a recurring basis upon tenant turnover. So when they put the suites up for rent, that's when they'll update the flooring and the appliances and painting, and they do a lot more painting than most other managers, mainly because they tend to paint their suites to make them more attractive to rent out. So these are the amounts that they're doing on a recurring basis. So therefore, they're getting the higher rents of $1,206 per suite for 1964 building. The only reason they're getting that because they're spending that amount in repair maintenance.
Okay. And well, I was just seeing your repair and maintenance that workup. Would it be? I mean, would you agree with me that flooring replacement and appliance replacement will be more like a capital expense rather than an operating expense? Because appliance replacement is, they're not going to do it every time there's going to be a turnover.
We've had this issue many times in the past, and the municipal board and the assessors have been settling past assessments by using appliance and flooring. So that's an old issue, and the assessors are agreeing that this is not capital expenditures.
Because as we see right now, I mean, I don't dispute the EGI or even the cap rate, merely what is the difference between us is the R&M expense, which I believe is super high for the property, which is being renovated extensively in the last 10 years. So, well, yeah, that's pretty much all my questions, Mr. Chair.
I thank you. Ms. McFadden?
Just one question. So in fact, however, your total expense cost is lower than what the city's assessment is?
Yep. Our dollar amount, the expense is 708 versus the assessor of 714. So we're actually lower.
Okay. That's all my questions. Thank you.
I thank you. Ms. Warhan?
No, thank you.
I just have a couple of questions. Biggest discrepancy, I think, is the rents that are attainable here. Is this because, Mr. DuPont, you're at 14,700,000, and the city's at 17 million. So one heck of a difference in regards to rental income.
Yeah.
Yeah, but like you say, proportionately, the expenses are, percentage-wise. I mean, you're coming in at 708, and they're at 714. So
Right. So our main difference is in the rents.
yeah.
And the assessor said he would accept the site-specific rents.
Yes.
So that we're using site-specific. That's what they're getting. And 1206 is quite high for a property built 1964, and the assessor of 1340 is extremely high for property at that age.
All right. I have no further questions. Mr. Assessor, summary if you'd like, or summation?
No, Mr. Chair.
All right.
Thank
I
you.
thank you. Mr. DuPont, your opportunity?
Is a summation, yeah. So the assessor is saying that the repair maintenance is high, and that the appliances and flooring may be a form of capital expenditures. That issue has been dealt with many times. I've been doing this since 1981, and we've been arguing repair maintenance ever since. And going to the municipal board, the assessor, when they do site-specific at the municipal board, they will use appliances and flooring expenses. So that's a normal thing. We've been doing that for years. It's been accepted. So I believe that the way we've stabilized this has been accepted. That it's a standard in the industry at the municipal board and the assessors when they do site-specific. Thank you.
All right, I thank you. That concludes that particular property. So we'll go to the sister building at 291 Goulet Street. Mr. Assessor, whenever you're ready.
Okay, just give me a second, Mr. Chair. I'm just going to pull up the file.
Absolutely.
Perfect. Okay, so 291 Goulet. File number is 242732. Roll number 0607-551-5000, 291 Goulet Street. 2025 assessed value at 14,180,000. Classification.
Mr. Chairperson, could you just get the assessor to repeat that roll number?
0607-551-5000.
Perfect, thank you.
Okay, thank you.
Okay, classification 20, liability is taxable. It has one building, 6-story, built in 1964. The effective year of built is 1964 to 1974. It has 105 number of suites, outdoor parking spot of 62. Moving on to page 2, it has the request for income information, which shows that it has been consistently be filed. So that is all good. Page 3 has income value summary, which shows there are 13 bachelor units, 60 one-bedroom units, 30 two-bedroom units, and 2 3-bedroom units, totaling up to 105. the average monthly rent per unit for this property is coming up at 1,182.22. Using that, we have the gross potential rent at 1489597, using model vacancy rate of 2.6%, and the expense rate at 44.78%. The NOI is coming at 801,169, using the cap rate of 5.65%. The value is coming at 14179,982, rounded off at 14180. So market value per suite is 135,047.62. Page 4, we have some rent comparables. These are some kind of similar rent comparables used in the previous hearing. So I think this is our wrong table. This is not a correct table. So I would like to just disregard that. I apologize to the board for this. Page 5, it has cap rate evidence chart, which is basically, it is a sample of actual sales that took place during the reference period. The purpose of showing this, these individual cap rate is to illustrate the accuracy of the model and substantiate the model-derived cap rates. They are not meant to be comparables specific to the subject property. Page 6, it has some cap rates from City of Winnipeg, Colliers, CBRE. It just shows that City of Winnipeg has the 20th and 80th percentile of 4.75 to 5.45. Then we have municipal assessment excerpts at page 7. Page 8, we have a image from Google Maps showing that where the property is located. And we have some photo, the exterior photo for the building, and some permits, same thing as 261 Goulet for the renovations, and some financial statements on page 11 and page 12 for the last from 2019 to 2022. I would like to recommend the board to maintain the current assessment at $14,180,000 for this property. Thank you.
Thank you. Mr. DuPont, questions?
No questions.
I thank you. Ms. McFadden, questions?
I do have a question. So this is a sister building to the previous property, correct?
Yes, correct.
Would you say that it's had similar upgrades to the previous property?
Exactly the similar case as the previous property.
So why the huge discrepancy in the average rent per unit? Huge discrepancy, $200 a month.
Exactly. I mean, that's why I did not contest or provide any arguments to the previous one that it was high. I accepted Mr. Henry DuPont's suggestion that it should have been at the actual calculation.
Okay.
But for this one, I feel it is exactly what Mr. Henry DuPont presented for the last one. So.
Okay. Thank you.
I thank you.
Thank you.
Ms. Warhan?
My question was just answered. Thank you.
Okay.
And can I just like to add on? I think the main difference is because the effective ages are different for those properties, for the buildings. The model average rent is calculating differently for these ones. For the last one, it was 20 years. For this one, it's only 10 years. That is one of the reasons, I guess.
Understood. Thank you.
Mm-hmm.
Not that that makes any sense, but.
Exactly. I mean, I honestly, I try to kind of roll back to see what changes and what, but I couldn't find any reason why there was a discrepancy for those ones. But
Yeah, it's
Thank you.
just presenting.
Yeah. Let me just look through my notes here. All right. As you say, this is all model driven for this property here. But Mr. DuPont, I think we're ready for your presentation. Yes.
Okay, so just jump to page 5, please. Okay, so that's a sister building. Parking is slightly different. This one has just 62 outside, the other one at 51. The square footage for each suite are a bit different. The bachelors were 399, now they're 364, and the one bedroom is now 549, previously it was 585, and 2 bedrooms are 824, previously 760. So the built around the same time, but they do have slightly different. Now they have slightly lower rents for subject line 3 at 1175 per suite, and the previous one was 1206, so they're relatively close. But the reason there's different rents is because over time there's different turnover for every apartment, and therefore the amount of money that's spent on repair and maintenance, and it all depends on when tenants move out and when they move in, etc. So it's impossible to keep them the same. So even though they were similar, so that you would have different vacancies, different rents, different repair and maintenance, and this one had the higher expensive, well, slightly higher taxes. The utilities are a bit higher also. Anyways, they're all site specific. They're all different. They should not be exactly the same value, mainly because of the tenant turnover over the years that made it differently. So we have pretty much the same rent now. Line 3 is what the assessor has, and after we allow for vacancy, and then the laundry and parking, line 13, we're 1478 versus the assessor 1450. So we're actually 28,000 higher, which is relatively minor. Expenses, line 31, we're at 728, the assessor is 649. So that we're higher there. So most of our difference is in the expenses, and not in the cap rate, and it's not in the rents. So we're going site specific as per normal. So nothing's really unusual, nothing out of line. So we go with the stabilized year averages for 3 years for normal items on a standard basis. We go actual 2022 for insurance, utilities, and taxes as we normally do in caretaker. So the repair minutes is on the next page, page 6. There again, we have 5 years. They had less work done in 2018 than the other property. So the amount of repair minutes that they put in specific years and specific things are different. And just because they were sister building originally in 1964 doesn't mean they still remain that way. So we stabilized pretty much the same as what we did the last one. We excluded the high years. We maxed out the appliance replacement at 225. So we took the average between 2018 times a certain percentage to make it to the maximum. And painting also, we removed the 2 high years, and then we went 94% of that. So just make it a maximum 225. Globe General tends to repaint every suite that's up for turnover. So it refreshes the suite. So they tend to paint their suites more often than other managers. So their repair maintenance tends to be higher. So when we do a maximum of 225 per suite, it's more for general type management. And they tend to be higher, mainly because they have they put more into their turnover to make the suites more rentable and to get the higher rents. That's the way they operate. So the repair maintenance that we have is stabilized at 2230, and that's what we input in the previous page. So the repair maintenance should be considered because that's in relation to the rents. They would not be getting those rents if they did not have those repair maintenance. And they're doing the flooring and the appliances on a recurring basis. So it's not as if they did 1 year, a whole bunch of it, and then none the other year. So this is recurring. And so our value, the cap rate, line 34, we have the same cap rate as the assessor, and now our value is 13,269,000 versus the assessor 14,180,000. And that's my report. Thank you.
Thank you, sir. Mr. Assessor, questions?
Yes, Mr. Chair. I would just like to carry forward the same questions we had in the previous property hearing for R&M, just super high for a property with major repairs done in the last 10 years. That's pretty much it.
I thank you. Ms. McFadden?
I have no questions. Thank you.
Thank you. Ms. Warhan?
No, thank you.
Thank you. Mr. DuPont, your gross rent is almost the same as the city.
That's right. Yeah.
Okay.
Mainly
But,
because of a lower effective age. Yeah.
But the discrepancy is the expenses. Your expenses are close to 100,000 over the cities.
Yeah, about 80,000 higher. Yeah.
Yeah. Okay. Okay. I think that's all the questions that I have. So, Mr. Assessor, summation if you want.
No, Mr. Chair. That should be all.
Thank you.
Thank you.
Mr. DuPont? Summary?
None. Thank you.
All right. Let's go on to the next property, which is another one on Goulet, which is 302 Goulet Street. Mr. Assessor, whenever you're ready, you can take us through that property. You're muted. You're muted.
You're muted.
All right.
Sorry for that.
That's okay.
The file number for this property is 242211. The roll number is 0609 301 8500. Address is 302 Goulet Street. The 2025 assessment is at $12,873,000. Classification is 2-0 and liability is taxable. It has 9 buildings with 2 stories, built in 1949 with effective year of built of 1974. It has 100 suites and 94 outdoor parking spots. Okay, page 2, we have request for income information schedule here. So it's all fine. They have been compliant with that. No sale history as such. Just in 2003, there was a sale. I believe it's a land sale. Page 3, we have income value summary for the property here. So it has 41 one-bedroom units, 59 two-bedroom units, totaling up to 100 units, with 1,111.99 average monthly rent per unit. Using that, the gross potential rent is coming up at $1,334,388. We're using this model vacancy rate of 2.6% and the expense ratio of 45.03%. And the NOI is calculated as $714,442. Using cap rate of 5.55%, the capitalized income is coming at $12,873,000 rounded off, which is calculated for market value per suite as $128,730 per unit. Page 4, we have some rent comparables, which which shows that the effective area of built is ranging for the comparables between 1968 to 1993. The total number of units is ranging from 27 to 156. The gross floor area per unit is ranging from 885 to 1473, and average monthly rent per unit is ranging in between 1,039 to 1,568. And moving on to page 5, we have that same cap rate evidence. Same thing, it's just a sample. So it's not a comparable specific to subject property. Page 6, we have cap rate for different City of Winnipeg, Colliers, CBRE, Cushman, and Wakefield. Page 7 has municipal excerpts. Page 8 has photos of the building from inside and outside, and some information from the website on page 9. And then we have permit on page 10 with some more information from the website and satellite view of the property. And page 12 and 13 and 14 will have the income and expense information that was submitted by the company to the city. I would like to recommend the board to maintain the current assessment at $12,873,000 for the property. Thank you.
Thank you. Mr. DuPont, questions?
Yes, would you agree that this property does not have central air conditioning and most suites have no air conditioning?
Yes, I agree. Only few, I mean, not all of them, but select units have air conditioning.
Right, okay. So on page 9, the description is that the flooring, they have hardwood floors in some select units, some vinyl planks.
Mhm.
And some of the appliances, I guess most of the appliances are stainless steel appliances. Do you know specifically when it was renovated?
Specifically, I mean, the permit is from 2013. So I'm not exactly sure. Yeah, so it would have been 2013 onwards.
Was there other permits? Because that permit is relatively small.
Yeah, I mean, that was the only permit that was on file. Now that is because there was other permits too, because there are 9 buildings on the property. So every building has the same permit. So I just posted only one
Oh, I see.
for the
Okay.
evidence. Yeah, so there's 9 permits, exactly similar cost of construction for every building.
It's all questions I have.
I thank you. Ms. McFadden?
I have no questions. Thank you.
I thank you. Ms. Warhan?
Just one, you've had the cap rate 5.65 for the other addresses, and this one's at 5.55. Well, what's the difference there between the other buildings?
I mean, the gross floor area is different. It has different parking spots. This one has 94. The other one has very, very low. And same thing, the effective area is this one has 25 years, if I'm correct, on the building, but the effective ages. The previous one only had 10 or 20. So yeah, I mean, these are the difference on some features of the building. That's why it's at 5.5. And it's a model derived rate, so that is why.
Thank you. That's all, Mr. Chair.
I thank you. Mr. DuPont brought up the question about there's limited air conditioning to these buildings. There's 9 of them, are there not? So not all of them have air, and it's, what would you say, percentage-wise, 50%, or in that range, or?
Yeah, I mean, it's not exactly clear how many of them has it or not, because there were no specific amount provided in terms of information to that. But it just says there is only select units now. Because,
I'm sorry, go ahead.
yeah, because now the website information that I've kind of placed in, this information is for, if I'm correct, is only for one building. There's 9 buildings.
Yeah.
So I'm not sure how many of them would have it, or
Okay.
that's why.
I also note that there's no balconies in this building at all. So is that a deterrent factor in regards to, people that are renting properties?
Yeah, I wouldn't say it's a deterrent factor. It's very common in that area that there will be properties without balconies, especially on Goulet. There are like very similar properties. So for me, I would not say that's a deterrent factor.
Okay. And does the model recognize that at all, or or?
I would not be able to. I don't know.
Just a
if the
general,
model, yeah,
just a general question.
yeah. Usually, in terms of information that I have right now, I would say that it might have an impact on some certain information regarding the area that might change if the balconies are added on to the building. So I believe it should consider the factor if there's balcony or not.
Yeah. I thank you. Mr. DuPont, the floor is yours for your presentation.
Okay. You can go to the first page. You see one of the photos. There is in this property, and so if there would be air conditioning, would be the windows, because they were not built with air conditioning, so they would not be sticking out of the walls. They would not be wall air conditioning. Basement suites, there's 2.5 stories, so most basement suites would not have air conditioning, but they could, I guess, if they put some in the windows. There's none shown in those windows. Both that photo. Now I guess the appendix, we pretty much have the same thing as what the assessor has. The amenities is that they basically say that there's air conditioning and select units only, dishwasher and select units only, so they don't have that in most units. And they have some of the photos shown. So they have stainless steel appliances, which is an upgrade. A lot of the newer suites don't. Some of the upgraded suites don't have that. It appears they still have the old windows. A lot of them still have the hardwood floors. Now, our page 12, it shows you where it is, the 9 buildings at Goulet and Enfield. And if you live in the area or travel there, these properties were nice shore in St. Boniface for many years. They were white stucco buildings, and they were falling down, and they had low rents, did not do well. We had appeals on them going back to pre-renovation days. And now they have it 1974. So page 17. So we see that we use 5.75 cap rate. And I guess we have a typo, page 17. At 1949, wood frame, no balconies, suites and half basement, and air conditioning select units. So the our cap rate for that age group is 5.5 to 6.25, and because of its negative features, mainly no air conditioning, we believe it should be 5.75. So page 18. Now we don't state that, but I pulled up the information we had on this. It was renovated in 2012 to 2013, so I believe the assessor was guessing right with one of the building permits. The assessor issued a supplement the first time in 2015 to recognize the effective age. And the rent control was rent control exempt until October 2019. So it's the type of renovations where they did the whole building at the same time, so they can be exempt from the rent control instead of doing it one suite at a time. So when they did the renovations on that, they got exempt from rent control. So when we do our income approach, page 18, we start with 2020, so that's a year after they were exempt from the rent control. And the vacancies were page 18, so vacancy is relatively high, line 5 at 6%, 6.4, 5.5. And the rents are getting the discounts, etc. So they, I guess they went off rent control and they had the highest rent that they could on paper, but then they were giving discounts. And then they have the vacancy pushing back, market pushing back. So line 3, we stabilized at 1305, which is the actual rent they got after discounts, which is 1088 per suite. The assessor is 1112 per suite, so we're relatively close there. And then we have the 5.5% vacancy. Then we add laundry and parking. The assessor has none. So line 13, where 1301, the assessor is 1299, 694. So we're almost the same. So we're about 1,000 higher in effective gross rent. So that's a very small difference there. Expenses were line 31, we're at 678, and the assessors are 585. So the assessors is quite low expenses. Our repair maintenance is relatively low, line 27, it's 1176 per suite. So the repair maintenance is not what's bringing our expense ratio higher. It's likely to do with taxes, utilities, and insurance, so the normal things. So line, sort of page 19, where we do the stabilization or repair and maintenance, they don't give much details, but we show the expenses each of the years. We show what we stabilize. So we stabilize windows and doors, the average, HVAC mechanical average, and remaining R&M average. So we stabilized 1176. It was just the 5-year average that they had. So back to page 18. So we have a difference in the expenses. And as stated, it's not in the repair and maintenance, it's other items, the normal items, which would be insurance and taxes and utilities. So we apply a cap rate 5.75. We get a value of 10,825,000 versus the assessor at 12,872,000, so about 200,000 less. Yeah, that's be my report.
I thank you, sir. Mr. Assessor, whenever you have questions for Mr. Dupont.
Yes, just a few questions, Mr. Chair. Mr. Dupont, can we go to page 17, please?
Yeah.
Okay. So I just wanted to clear out because this page says that you agree with the cap rate of 5.55%. So are you using this cap rate or 5.75 cap rate to come up with a value?
The 5.55 was probably our initial analysis. Then I decided for this hearing to use 5.75, mainly after looking at the fact that they had no air conditioning in the suites. So I changed the report. So I should have changed page 17 to 5.75.
Okay. Yeah, so yeah, I see that our effective gross income is like there's basically no difference there. But yet again, if I'm looking at the vacancy, it's pretty high. especially between 2020, where there has been, if I'm looking at the R&M expense, has been pretty high. So would you agree that your vacancy was related to the major expenses done to the property?
That was related to that?
Yeah, I mean, because from 2019, the total R&M expenses were increased from 240,000 approximately to 414, and then 369, and then 517 in 2022. So would that be a correlation with the vacancy where we see here, which is 74,000, 80,000, and 72,000?
The repair and maintenance is quite low for apartments of this age. And it's low mainly because it was renovated in the past, and therefore they need to replace the appliances and flooring less often than other apartment blocks. So the repair and maintenance is not high in any way, and the vacancy is not related whatsoever to repair and maintenance. It's related to the fact that they have higher rents in the market is willing to absorb, so there's the market pushing back. So they expose their apartments at certain rents, give it certain discounts, and they end up with certain amount of vacancy. So it's totally related to the rents that they're asking.
Okay, yeah, that'll be all the questions I have, Mr. Chair. Thank you.
I thank you. Ms. McFadden?
I have no further questions. Thank you.
Okay, I thank you. Ms. Warhan?
None, thank you.
I note, Mr. Dupont, that, like you say, your gross rents are similar, fairly close. But the only discrepancy is you are at 52% and the city's at 45% expenses. And there's a different cap rate.
Yeah, so it's mainly in the expenses because the rents are effectively gross income basically the same.
All right. All right. I thank you. Mr. Rehan, summation if you want.
No, Mr. Chair. Thank you.
I thank you. Mr. Dupont, summation.
None for me, thanks.
All right. Does anybody need a break or anything like that, or can we go on? Up to you. Anybody?
I'm fine. I'm fine.
Okay.
I'm fine.
Okay, let's go on. Okay, we'll go to the next property that we have is 303 Goulet Street. Mr. Assessor, whenever you're ready.
Here. Let me just pull up the file. Just give me a second,
Yep.
please. Okay, sorry for the wait. All right, so the next file number is 243311. Roll number 0607-552-5000. The address is 303 Goulet Street. It has 2025 assessed value at $12,726,000. The classification is 2-0. Liability is grant. Number of stories 10. Number of building is 1. It was built in 1973. There is no effective year, so it's similar to the actual year. Number of suites is 162, and outdoor parking spot is 20. Page 3. Moving on to so I'm not gonna dwell on the page 3 here, income and value summary. I would like the board to just move forward to page 5 of my presentation, please. Now the property is senior housing, so I just had calculated the CMSC average market rent based on 3 different categories here. So one was zone, era construction, and structure size. So our model rent is only 84.56% of the market potential rent. For this property, this is a senior housing. And then on page 7, I have just kind of provided tables that I used to come up with the value for those potential rent for CMHC. I've just highlighted the values that I used. Page 8, same thing. We have that cap rate evidence. Page 9, there is the capitalization rates table for the industry. And then page 10, municipal assessment asserts. Page 11, there's an exterior photo from the website. And then some information on the building about the amenities, the rent and availability, and the map. Yeah, I mean, there is a permit on the last page, but I guess it's only a very minor permit, but it's just there for information, nothing more. So I just like to recommend the board to, we're using the cap rate for this one is 5.55%, and the value is 12,726,000. So just like to make a recommendation to the board to maintain the current assessment of 2025. Thank you.
Great. Mr. DuPont, questions?
Now, when you do comparables for Shimichi rents, that has nothing to do with parking. That would be strictly rents.
Yeah, these were just average apartment rents based on different categories.
And what is the reason you're going 85% of Shimichi rents?
Well, I just took out, as I said, I mentioned, I calculated this based on the weighted average of using the area, which is in Boniface. And so I was kind of, I've highlighted the tables on page 7, that these are the values that I've used to calculate it. Like bachelor units, 2022 average rents were $820. The 1-bedroom, October 2022 average rents were $1,070. So, I mean, these are the values I use to calculate the CMHC average market rents.
Oh, so you're the one that calculated those tables. That's not the model that did that?
Yeah, the model rent is only 84.56%. The model rent is coming up at $1,483,272, which is $760 per unit monthly.
Do you know why the model rent is at 85% of the Shimichi rents?
That's because we value it lower based on the age of the building, which is 1973, and there's no evidence of any improvements or renovations. And also there's a factor that this property is not being run at highest and best use.
What factor is that?
That this is senior housing. So the rents are not actually what they could have been on average market.
Isn't it because it's social housing, rents below markets, nonprofit?
I mean, that's what I mentioned. This is senior housing. So this is not being run as highest and best use. And we, in the city, the main criteria for valuing is what the property would sell at its highest and best use.
So there's a lot of seniors housing or for-profit that have higher rents or 100% of Shimichi rents. You would agree with that?
Yeah, I mean, there must have been different housings, but for this one, this was not, it is a non-profit. It's not a for-profit.
Do you have any cap rate premium for the fact that it's non-profit?
No, as I said, the cap rate is based on what the property is valued on highest and best use. It does not give any discounts or premiums for special housing or senior housing or Manitoba housing.
That's all questions I have.
I thank you. Ms. McFadden, any questions?
Mr. Assessor, have you ever inspected this building?
No, ma'am, I haven't.
Have you ever looked at any of the MHRC portfolio buildings?
Are you asking like if I have looked at any of those buildings in CMHC apartment rents?
They're
Or?
not CMHC, they're Manitoba Housing Renewal Corporation, correct? So they're
No.
owned by the Manitoba government, this building. It's not owned by a nonprofit, it's owned by the government. Is that correct? It says the owner is MHRC.
Oh, so yeah, the owner is Manitoba Housing. Yeah, it's Manitoba Housing. I haven't done any inspection on any of those properties. No.
So you don't know that you can't differentiate between other nonprofits at this building or for-profits in this building in terms of the condition?
I mean, and based on the condition, as I said, I believe the condition is just an average or maybe a below average condition for this property.
And does it tell you that on the cap rate? Does the model have an condition?
I mean, yeah, as I've answered to Mr. Henry too, the 5.55% cap rate is our model derived cap rate, and that is basically it's valuing the property on the highest and best use. Like, how would this property sell on a market for if this was a for-profit organization? Like right now, this is a nonprofit.
Okay, thank you.
I thank you. Ms. Warhan?
My question was answered, thank you.
I have no questions. Mr. DuPont, we're ready for your presentation.
Before I forget, our cap rate study should be entered into evidence. And I guess the previous properties, we didn't have that much difference in cap rate. So here, I think we don't have much of a difference in cap rate for the base cap rate, and it's solely on the premium for the fact that it's physical features and the social housing. But I would still like to say that the cap rate study should be entered as evidence, and I can just go just really quickly on that. So our report, page 2, you'll see it's a high rise on Goulet. We've got the maps, etc. The cap rate page, page 15. So the subject built 1973. And so our cap rate base for that is 5.5 to 6.25. The assessor, the city tends to have higher cap rates when they have a higher number of suites, so that this property is 162 suites, and this should be one of the properties, but they have higher cap rates. So they're like the 291 Goulet, 261 Goulet had 5.65 cap rate. And a lot of that is due to the model picking up the fact that a higher number of suites. And this one has a higher number of suites also. So that the page 15, so we have some of the factors here, so that the income, it's social housing, senior housing also on top of that. Condition, we say average, likely on the low side, because Manitoba Housing has a hard time keeping up the repair maintenance. Parking is only 0.12 per stall, so very low parking. Suite mix, they have 100% bachelors in one bedroom, and no 2 bedrooms. Suite sizes are very low. Bachelors 360 square feet, the 1 bedroom 480 square feet. So we use the cap rate of 6%, which is 0.5% more than our base cap rate of 5.5%. And the next page, page 16, it shows that we agree with the assessor's NOI. So we don't dispute the NOI. And so they have 5.55. So we're using 0.5% above our base. Our base is 5.5 to 6.25, I believe. So we could be going higher than that. And the fact that it has 162 suites, I'm surprised the assessor has not gone with a higher cap rate, because we have a lot of older apartment blocks built in the 60s and 70s where the assessor has 5.65 to 6.25. And this one, they don't. So I'm surprised they don't have a higher cap rate due to number of suites. Top right of our report shows the factors. It's a 12% parking. It's 126 suites out of 162 has bachelors, so it's 78% bachelors, which is very inferior type of suites. So if you put that on the market, it's less desirable because of so many bachelors, too many bachelors. And the gross floor area, the total, including the corridors, is 557 square feet. So extremely small gross floor area per suite. So due to those factors, physical factors, as well as the fact is social housing, we're going 6%. Now we talked about the social housing. Page 12. So I have quotes from previous municipal board decisions and the appraisal journal saying that low investment grade apartments warrant a higher yield and overall rate than conventional apartments. And municipal board order basically says the same thing. The last paragraph of page 12 says the board is of the opinion that the cap rate does not adequately reflect the fact that subject is more of a high risk investment than the assessor comparable due to the fact of social housing. Some more quotes, page 13 and 14 also. And we have also some more information in the appendix, so that we have a section, page 21, cap rates for affordable housing. So we repeat some of the stuff we have in the body of our report. And then we have the full order of AO2-330. And then we highlight some parts of that decision. And we have, I believe, another decision also, AO3073. That's the same thing. So the municipal board has found these two decisions of higher cap rate should be applicable for social housing. And on top of that, we have negative physical factors. So the high amount of bachelors, very small suite size individually, very low parking, 12%. So I believe the cap rate premium 0.5% is adequately supported here. Thank you very much.
Sorry. Mr. Rehan, whenever you're ready, you can ask Mr. DuPont questions.
Yeah, I have no questions, Mr. Chair.
I thank you. Ms. McFadden?
I would just like to go back to the assessor for a second.
Yeah.
To the comment that you made about highest and best use.
Yes.
Just to clarify what you mean by that. Are you saying that this building, exactly as it is, if it was owned by a for-profit owner, would actually not present, would have a cap rate, would justify a cap rate of 5.55? So very small bachelor units, little parking. You're saying that this building could actually be profitable? Is that
Yes,
what you're saying?
with the highest and best use, what I mean is basically if this property is run in a for-profit way, then obviously there is no like a rent cap, or the average rents would be higher. So there will be a different NOI, the cap rates will be different. For us right now, when we're valuing this property, we're valuing this property at a below average quality, because we know this is Manitoba housing, so we're not using those average market rents. So basically, based on that, the cap rate is 5.55, but if you look at my income value summary, in the end, there is market value per suite, which shows that it is only 78,555 per suite. Like if I go in the market to look for like a condo or like that, would I get it for 78,000? I believe not. So just based on overall all the things, my
Sorry,
value recommendation.
Okay, you believe not at 350 square feet a unit? Like these
I mean,
small. These are very, very small units compared to what's generally available on the private market. Would you not agree?
generally, yes. I mean, and if I have to be that, it's not. I've been into those apartments, but not as an assessor. I've been there. I've seen it. But yet, I mean, mostly these are for senior homes right now. So this is a very, I would say, specific market that they target right now. It's not available to open market. So if based on that, I believe 5.55% cap rate would be fair. That's just my opinion.
Okay, thank you. That's all my questions.
I thank you. Ms. Warhan?
None, thank you.
I thank you. So all right. Because it's social housing or Manitoba housing, you feel as if the model is justified at the cap rate of 5.55?
Is that a question to me or
Yes.
yeah?
Yes.
Me.
Yes.
Yeah, I mean, based on overall all the things, based on the average monthly rent and the income coming in, because right now we don't have exactly the income and expense from this applicant, because obviously this is not run in a for-profit way. So I believe 5.55 would be a fair based on the below average condition. It shows that this is a risky investment at 5.55.
There's only 20 stalls for 162 units, so that's a deterrent there. So
Yeah.
you know,
Yeah, that's basically because there is more bachelor units rather than one bedroom. So
all right. I thank you, Mr. DuPont. Your presentation.
No,
were
I
we-
did that already.
Or are we?
You
Are we? Okay, I'm sorry.
you guys cross-examined in this session when it's my turn to cross-examine me.
Okay. Let me just go back to you, Mr. DuPont. Your NOIs are exactly the same.
Yes.
So the thing in dispute is the cap rate.
Yes,
Right.
correct. Yeah.
Okay. All right.
I do have one additional question, Mr.
Go
Mayor.
ahead. Go ahead.
And this is for Mr. DuPont. So on page 33, you talk about the sale of a Manitoba housing property to the private sector. So this is a building that the private, can you give us a little more information about that sale? Because I think it goes directly to kind of the assessor's point about the level of risk that's available or that's present in the purchase of this type of building.
I don't have a page 33.
Page 33.
Well,
It's-
I have a
Yeah, I'm noticing my pages are not lining up with what you're talking about.
oh, I see. Okay, we have different page numbers.
But it's a news release in your brief that talks about Manitoba Housing announces plan to sell Winnipeg property, and it's all 185 Smith. It's in your
Okay.
appendix. You can't find that one?
No,
Okay,
maybe
you know what?
maybe I open
I'll go by Yeah, I'll go by the page numbers. So it's on the number that's on the bottom of your page. It's page 45.
okay. I noticed I got 2 reports I had online. So
Well, maybe that's what this is. I don't know.
oh yeah, okay. Page 45. Yeah. Okay.
And
So I have it now. Yeah.
Yeah, and the previous several pages are talking about that sale. Correct?
Yeah, and it says the underlined, highlighted is due to 500 million in deferred maintenance costs our government inherited, etc. But the building system had been repaired, but given the size of the structure, would be cost more than 20 million for the province to complete and renovate the Manitoba housing specifications, etc. So the MHRC tends to be behind repair maintenance on most of their properties.
Which would increase the risk. Is that what you're suggesting? That you're
Yes. Yeah.
Increase
Yeah.
the risk when assess it.
Yeah. So the social housing and in general are a low grade investment, but for MHRC, they're also saying these articles that they're not keeping up with maintenance, and there's a lot of deferred maintenance in their projects.
Okay, thank you. That's all my questions. Sorry, Mr. Darren.
That's okay. I think we're at a summation for Mr. DuPont, if you want.
None.
Okay. All right. So let's go on to the next property, which is 431 Goulet Street. Mr. Assessor, whenever you're ready.
Sure. Thank you, Mr. Chair. Okay, perfect. All right. The file number for this property is 241502. The roll number is 0608162200. The address is 431 Goulet Street. The 2025 assessed value is $2,375,000. It is classification as residential 2, and liability is taxable. It has 1 building and 2 stories, built in 1960, no effective age. It has 23 number of suites with 22 outdoor parking spots. On page 2, we have the request for income information, which shows that it has been compliant in providing information to the city on the income and expenses. The subject sale history is dating back to 2004, which shows the SORN value or the sale price of 1.165. Page 3 has the income value summary for this, which shows there is 1 bachelor unit, 10 1-bedrooms, and 12 2-bedrooms, totaling 23 units at an average monthly rent per unit of $910.95. So based on that, the gross potential rent is coming up at $251,422. We're using the same vacancy model derived rate of 2.6%. and expense ratio of 51.02%. The NOI is calculated as $119,945. Using the cap rate of 5.05%, the value is coming up at $2,375,000. It is 103 260.87 market value per suite. Now page 4 has the rent comparables. It shows that the effective years are ranging for the comparables from 1952 to 1968. The gross floor area per unit is ranging from 801 to 952, and the average monthly rent per unit is ranging between 910 to 1039. Page 5 has the capitalization rate evidence, which is basically a sample of actual sales that took place during the reference period, and they're not meant to be comparable specific to the subject property. Then we have the cap rate evidence of the industry, 6, and then page 7, we have municipal assessment excerpts. Page 8 onwards, we have the income and expense information provided from the owners here. We have the financial statements, and then following on, there are website information and the satellite view of the property on where it's located. Based on this, I would like to recommend the board to maintain the current assessment at $2,375,000 for 2025. Thank you.
Thank you. Mr. Dupont?
Your page 5, your cap rate comparables.
Yeah.
Do you have any of the income approaches in your report herein?
Yeah, no, we don't have it in our reports, but these cap rates are calculated based on the 3 years of the stabilized income and expenses.
Well, we don't know how you stabilize any of those properties.
Unfortunately, we don't have that information to put it out here.
Any of those properties, you use the previous year's income. Did you use any of the market rents or the actual rents at the time of sale on any of those?
I would not know that right now.
That's all questions I have.
Thank you. Ms. McFadden?
This building is built in 1960. A 5.05 cap rate seems quite low for a building of that age. Can you explain that a little bit further for me?
Sure. Yes, this building is built in 1960. I mean, the low cap rate is basically based on the number of units, which is only 23 units.
Because it's very small.
It's very small. The location is good. It's near downtown, and there is parking spot per tenant, except there's there's 22 parking spots for 23 units. So and the property is in average condition.
Sorry.
You got it in time, Linda.
Sorry about that, guys.
Okay.
Of course, it does it when I'm unmuted, right? Same person called in the middle of my last hearing.
Okay.
Anyway, sorry, Mr. Assessor, you can go back to your explanation.
Yeah, sorry. So yeah, as I was saying, this is basically the 5.05% cap rate is basically showing that there's only 23 units. It's not a big risk investment. The value is at 2.375. And for these kind of properties, there will be more buyer interested. It's not a high valuing property. And then there is no desirability issue too, where there is a decent suite mix of the property. If we can go back to our income value summary, it shows that there are 10 one-bedrooms and 12 two-bedrooms, and there's only one bachelor unit out of 23.
Okay.
They have parking spots for every suites, and I believe there's only one suite which might not have a parking spot. That might be a bachelor unit. So, I mean, based on all those things, 5.05% is model derived cap rate for this property.
Thank you.
Thank you, Ms. Warhan.
No, my concern was the cap rate also being that low, but I think the assessor has answered that. Thank you.
I thank you. It's my understanding that the model takes everything into consideration, but particularly the age of the subject that they're valuing. So I have a tough time with the explanation in regard to, it's based on the number of suites. I don't, I can't I can't believe that that is the case. So um, it was my understanding that everything is taken into consideration, but the age has got a bearing on it too, and thus, if you have an older building, you have a higher cap rate.
Yeah. So to address that, as I mean, it's not just number of suites, and
No.
it's not either the age too of the property, because it's everything. It's about the risk on the property. And if I would just like to take your attention to page 5, where I presented the capitalization rate evidence. I mean, I'm not saying that these properties are exactly similar.
We've seen this, and this is just an explanation as to how the cap rates are derived. This has got nothing. This is part of your model. It
Yeah.
is we've seen it plenty of times. I don't really agree with it because
Okay.
it's just information for anybody that's looking to see how you do cap rates. But it's got nothing. It doesn't really pertain to the subject property.
Okay.
Okay,
All
so
right.
I can see your point in defending the model. Yes, I can see that. But my question still comes back. We have an older sort of apartment building. It's a walk up. It's got 22 units. It's got 23 parking spots, and you're using a cap rate of 5.05, which
Yeah.
is almost applicable to, you can say they're smaller units, but it's also the age, it's also the location, etc. So I just, as Ms. McFadden said, it seems to be a low cap rate because we see a lot of this going on.
No, I mean, as I said, I mean, the cap rate evidence aside, based on everything, the cap rate is calculated on all the features of the building, including the age too, right? I mean, at the end of the day, it's all in my opinion, that would be how much risk is involved with the building, if anybody is willing to buy, and then the next thing will be, is the property has that stabilized net operating income or not. Now, based on the financials, this shows that the property has has a stabilized NOI. It has no issues with the rents. It has stable rents. So the financial statements are stable. It has, I mean, the condition is 1960 as the age, but right now we have no information if the property has seen any improvements or not, because we haven't inspected it. There are no photos we can present. So I'm not going to say to the condition of what it could be. But based on the risk element, I'd see that 5.05% would be fair, in my opinion.
All right. Thank you. Mr. DuPont, your presentation?
I ask the assessor one more question.
Absolutely.
Can you confirm that this property does not have air conditioning?
As it seems, yeah, there is no indication that this property has central air conditioning.
Thank you.
Mr. DuPont, your presentation?
Okay. My report, and it appears I started off at page 8. So my pages are a bit strange. So the first page where we show the photo, you can see the exterior has no wall air conditioning or no air conditioning in the windows, indicating it has no air conditioning. Then we have the maps, etc. The page 18, built 1960. And the top line on page 18, which is the assessor's cap rate 5.55 and etc. That's from an old report, and I forgot to change it. So you have to go to page 19. The assessor's at 5.05, and I'm at 5.75. So the page 18 is a typo on top there. I forgot to update that. So the cap rate for that we have for this age group, 1946, 1969, 5.75 to 6.50. We use the low end of our base, 5.75. And then comments to subject 1960s wood frame, small gross floor area per suite, 811 suites, no balconies, suites and half basement, no air conditioning, except tenants' own window AC. So the tenants can put their own. So the next page, page 19, you see line 13, they obtained 260,000 Sussex statements. Doesn't give you the vacancy potential or anything like that. So we end up with a slightly higher EGI than the assessor on line 13. Line 31, we have slightly higher expenses, which is offset to the net operating income. Line 33, we're slightly higher NOI, 125,000 versus the assessor, 119,000. So we're slightly higher than the city. So our case is on cap rate. So we use 5.75 versus the assessor 505. And we stabilize the repairment units on the next page. It shows each of the items. We stabilize that. We get to 1703. So then the appendix, page 21, the Sussex ad, they don't show photos. And the description doesn't say very much. So it shows the building amenities, and they don't show air conditioning. It's one of those things, but they say it's a good location. It's near a Safeway or Shoppers or whatever it is. So they don't say much. The page 25, the description of the property and where it has air conditioning, they don't check either one. So if they had central AC, they would have checked that. If they had wall AC, they would check that. So this not checked. So they basically reported no air conditioning. So that would be my report on this. I would like to present our cap rate study or talk about the cap rate study a little bit because it's a major issue for this property. And I'd like also to give a verbal rebuttal to the assessor's cap rate.
All right.
Can I do that now, or do you want to
Yes.
cross-examine
Yes.
me? Okay.
Yes. Yep.
To the assessor's cap rates, they don't show how they arrive at them. They don't show the income approach. They don't show any supporting documents. Now, 459 Sergeant, there's a MLS listing showing that the annual gross income was higher than the previous year's rent. So they had higher rents at the time. So the assessor, when they use the historical income stream, they're ignoring the actual rent at the time of sale. 150 Hendon, that's part of our cap rate. The rents were increased by the vendor prior to the sale, and they came into effect on the date of possession. So that would be in our cap rate. The assessors using the historical rent, and they're not using the market rents at the time of sale or the actual rents at the time of sale. And we have RTB orders, etc., in our own brief, so that our own brief will be a rebuttal to theirs.
You have a verbal rebuttal, Mr. DuPont? Yeah.
That's what I'm doing now.
Okay.
Oh, okay.
Okay.
677 Maryland, the assessor uses. They're using an older sale in 2020. There's a newer sale in 2023, and the price went down from 2,000,004 to 2,176. So the assessors purposely using an older sale when there's a newer sale. and which indicates a much higher cap rate. 2390 McPhillips is one of our cap rates, and then we use a market rents, which are higher than the actual rents at the time of sale. Some out at St. Mary's, the property was purchased with intent to renovate. We got a letter from the property manager D7 indicating that. At 32 Arden, the property was renovated after sale, so it's getting the intention to purchase for renovations. So that's my rebuttal. If you don't mind, I'd like to go to our own cap rate.
Yep.
So I have to find my cap rate. Oh, there it is. Big study, and we've probably seen it before. I don't want to spend too much time on that. We have the market reports we have down on page 5, and our cap rates we have for the list of cap rates we have is on page 12. It shows the 5 properties there on top, and then we show the 2 larger properties at the bottom. So 150 Henton, 2390 McPhillips. And those 2 were built in 1972 and 2015. 5.42% for Hendon and 5.59 for 2390 McPhillips. And then we show 677 Maryland, so that we use the most current sale price when the assessor has the older sale price. And 100 Maryland is built in 2017. It's a newer property and it's small units. Number suites is 11 and it's 5.44% cap rate. Now the actual cap rates on page 20 for a 150 Hendon. So I don't want to go through the whole thing, but the line 8, the effective gross income was 596,929 in 2020. They put it up for sale June 21, June 1st, 2021. By that date, they had increased the rents to 712,182. They had their rent application right after their year end in 2020, and that approval came in right on possession date. And now we're saying the assessor is not using those rents. It's mainly because they've said that in prior evidence, and because for 2023 cap rates, they had that comparable, and we had their income approach for that, and we know they were using the 596 rent and not the actual rents that they had at the time of sale. So we get 5.42% cap rate on that. And 2390 McPhillips, the next page, page 21. So line 3, 2019, they actually received 1,445,000 in rent, and we use 1,649,880, and that's the average rent from CMHC, which we showed. So they was bought top left in October 2020. Then we have the CMHC calculations on the next page, and then we have as evidence later on is that the page 21 is that the purchaser increased the rents by something like 25% after purchase. So they bought it, they increased the rents much higher than the actual rents that they bought at the time of purchase. Though the CMHC rents is in between what it was actually and what the purchaser increased the rents to. So we're using the in-between rents, more reasonable rents. And that's my cap rate evidence.
All right, we've got a little twisted here. So, Mr. Rehan, do you have any questions in regards to Mr. Dupont's presentation?
Yes, Mr. Chair, I have a few questions here.
Yep.
And the questions are regarding the cap rate study that Mr. Dupont submitted.
Go ahead.
Okay. So Mr. Dupont, I see that you've listed down here 1, 2, 3, 4, I guess 6 properties for your cap rate evidence, if I'm correct.
I believe 7.
Okay, so I see 345 Talbot, 677 Maryland, 738 St. Mary's, 100 Maryland, 150 Hendon.
Oh,
and
yeah, 7, 6, yeah.
6. Okay, perfect. And you've also listed you also done workup on all of those 6, right?
Yes.
Okay. So just starting off with the first one, which is 345 Talbot. I mean, would you kind of agree that there's only 1 year of a 1 year of income and expense information for your cap rate calculation?
Yes, and they had a sale brochure that we're relying upon.
Okay, sorry.
Yeah, so we had the 1 year, but when you sell or when we stabilize a property, we tend to use the last year for the income, the insurance, utilities, taxes. There's only a few items where we use averages, etc.
Okay, and then that's kind of similar situation with 677 Maryland. There's only 1 year of information from the income expense, and even for the 738 St. Mary's, where for 738 St. Mary Street, you only provided EGI of 2022, 2021, and there's no other information regarding the gross rents or any prior expenses or income information here. So is it based on CMSC average market rents, the EGI?
No, it says the top right line monthly rent payable 11,646, including discount for 15 units from the sale brochure. So that was from the listing.
But we only have 1 year of information, right? Is
Yes.
that correct? Okay.
Yes.
And for sale 4, which is 100 Maryland Street. I see that there's no actual data to calculate the cap rate here. So I was wondering, where did you come up with the cap rate of 5.44? Is it on the actual rents or actual expenses of the property?
I have to go in the appendix.
I guess it's page 9.
So what address do we have here?
100 Maryland. I think it's page, page 19, if I'm correct.
I'm going to the appendix. The workup is done again on page 84. We have a CMHC rent table. Then we have the brochure, the offering from Capital Commercial, page 86, 87.
But you have no information from the actual financials of the building, right?
No, so we applied the rents that we had from CMHC and used 40% expense ratio. Yes.
Okay. These are all my questions, Mr. Chair.
Thank you. Ms. McFadden, I think we're questioning Mr. Dupont for his presentation.
I have no questions. Thank you.
Okay, thank you. Ms. Warren?
None, thank you.
Either party one submission?
Yes, Mr. Chair.
Go ahead.
Okay, thank you. Yeah, so yeah, I would like to summarize that I feel 5.05% of cap rate is fair, reasonable, and the cap rate evidence provided by Mr. Dupont is kind of very unreasonable because there's no actual data to support it in terms of financials in the calculation there. So based on that, I feel 5.05% cap rate would be fair, and the value should be maintained. Thank you.
I thank you. Mr. Dupont, final word?
Yes, the assessor has no data whatsoever on their cap rates, no calculations of their cap rates. I have absolutely nothing to support their cap rates. And when he said they have no data, which is totally incorrect, we have data on every property. We have maybe only 1 year data on some. We have the pro formas, and Hendon and McPhillips who have 3 years data or more. And we have a lot more information than the assessor has on cap rates. Thank you.
Or thank you. Does somebody need a break, or just want to finish off the last one and that's it?
I'm ready to finish.
Okay,
All
can I
right.
just get 5 minutes to take a washroom break, please?
Absolutely. Okay, let's take 5 then.
All right, thank you. All right, we'll call the meeting back to order, and we'll do the last property we have on the docket, which is 389 Uville Street. Mr. Assessor, whenever you're ready, you can take us through this property. Thank you.
Okay, thank you,
He's
Mr.
done.
Chair.
All right, good.
The property file number is 241-802. Roll number is 0606-122-8000. The address is 389 Uville Street. The 2025 assessment value is at $1,414,000. Its a classification is 2-0 and liability is taxable. It has one building with 3 stories built in 2015. It has 6 number of suites with 9 outdoor parking. On the next page, we can see the request for income information, which is the company has been compliant in providing city the information for the income and expenses. On page 3, there is an income value summary report. We can see that there's 6 units. All of those units are 2-bedroom units. Average monthly rent per unit comes up to $1,483.30. Using that, the gross potential rent is $106,798. Using the vacancy rate of 2.6%, which is derived by model, and expense rate of 40.2%. The NOI comes up at $62,205. And using the cap rate of 4.4%, the value comes up to $1,414,000 rounded off, which basically makes it $235,666.67 per suite market value. On page 4, there are some comparables. I provided, as you can see, the effective AIR built for the comparables is ranging from 2019 to 2020. The mix of suites for Comp 1, Comp 2, and Comp 4 are kind of very similar, which only has like 6 or 5 units. And the average monthly rent is ranging from $1,350 to $1,588. Moving on to page 5, we have the capitalization rate evidence. As I've already explained, this is just a sample of actual sales that took place during the reference period and not comparable specific to the subject property. Page 6, we have the capitalization rates from different companies here: Collier, CBRE, Page 7 has municipal assessment excerpts. Now page 8 has the questionnaire information from the owners about the property and some financial statements following up on the pages. And then on the last pages 14 onwards, we can see photos of the building. We can see the exterior, the parking spaces, the AC units, and kitchen area, the bathrooms. I mean, as I explained, it's built in 2015, basically new. So with all this information, I would like to recommend the board to maintain the current assessment at $1,414,000 for 2025. Thank you.
I thank you. Mr. Dupont, questions?
Yes, so you have photos on page 16.
Yes.
So where did you get those photos?
It's from the website.
So 16 has some of the kitchen that appears to be a relatively small kitchen.
I mean, it's an apartment, yeah.
White cabinets. Yeah, you got more of the kitchen there on page 17. It's open concept. Your cap rate is quite low at 4.65, and that's because it's a small number of suites. Is that correct?
Not just that, it's basically it's the aero build too, which is only 10 years ago. And the small number of suites, and it's relatively new. So yeah, based on that, 4.4% is derived by model for this property.
On your page 5,
Mhm.
do you have a newer property with small number of suites in your comparables?
Are we talking about 2390 Max Phillips Street?
Is that the only one you have?
Yeah, that's the only one I can see built in 2015. Yeah.
And that's 90 suites, so it's not 6 suites.
Yeah, it is relatively larger.
So you don't have any evidence for the 4.65% for a newer property, small. 4.4. Did you get 4.4 cap?
4.4%, yeah, 4.4 cap rate. I'm looking at that. I mean, if you're looking at the table, then there's 727 Sargent Avenue, which is only 8 suites, is 3.46% cap rate, built in 1955.
Oh yeah, we don't know how you arrive at that though.
I mean, that's the only thing. We're not allowed to put that information out on our briefs here by the city. So this is the only table we can provide. I can tell you how we come up with that, but I can't give you a detailed explanation of all the things.
Page 6.
Yep.
That's where you show your cap rate, your 20th percentile and 80th percentile to call your CBRE Cushman. The multifamilies, the fort table there.
Mhm.
And then you start off at 4.75 is your lowest for high rise, low rise, etc. to 5.45. It's an 80th percentile. Then you got Collier's 5 to 6% for both high rise, low rise. CBRE is the lowest, 4.75. Low rise A, 4.5, and then Cushman 4.75 to 5.5. So we'd agree that the 4.4 is much lower than the brokers and your own 20th percentile and 80th percentile.
Yeah, but I mean, it depends on the type of property too. As I kind of said again, it's only 6 units, low risk, pretty much relatively new, built 10 years ago. The photos are there. Each unit has their own AC unit, parking spots. It's basically like a proper living space for a family with 2 bedrooms. They're very desirable, good neighborhood. So yeah, 4.4% is what the model has shown up, and I stand by it this time.
Show the assessments nearby. Isn't this an older part of the St. Boniface?
Can you say that again, please?
Isn't this in the older part, St. Boniface? Isn't there older houses nearby?
Yeah, I mean, yeah, it is an older part of St. Boniface, but it's a very kind of a desirable neighborhood for two bedrooms. It's very close to downtown. It has St. Mary's very closer, so the location is pretty good too. There's bus access. Yeah,
There's no bus access on Uville.
it's pretty closer to Yeovil. It's not exactly on Yeovil.
You'd be on Desmurins.
Yeah.
That's all the questions I have.
I thank you. Ms. McFadden?
I think my questions have been asked and answered.
Okay, I thank you. Ms. Warhan?
Mine also, thank you.
Okay, I thank you. Mr. DuPont, we're ready for your presentation.
Yeah, so the first page shows the building built is 6-story, and you see a relatively plain exterior, relatively new. Well, it is new, I guess. The map shows there it's on Bertrand and Uville. And then the next page, page 6, it shows it's east is the Murans, and it's older properties on Uville, and older houses there. And I believe they have also a Brunette monuments cemetery headstones. So the page 12. The line 3 shows 106,685. Then it says effective gross income is 104. So I think we have to go to the questionnaires. No, and I didn't include it. Anyways, we're slightly higher effective gross income than the assessor. But the effective gross income is actually 104,328. We agree to the assessor's expense ratio. That would change my NOI now to 62,205 to agree with the assessor. So we would have only a difference in cap rate. So if we use the assessor NOI with the 5% cap rate, my revised value would be 1,244,000.
1,244,000, correct?
Yes.
Okay.
Yes. It's a newer property in the cap rate comparable we have. We have 2390 McPhillips, and that one was, I believe, close to 5.5. We would use a minimum 5% cap rate for newer properties. We don't believe to go to a subpar 5% cap rate, especially for property that's small. And the location is not that great. And so it's, I believe, cap rate 5% is well supported. Thank you.
I thank you. Mr. Rehan, questions of Mr. DuPont?
Yeah, just a few questions, Mr. Chair. Mr. DuPont, would you agree that this old St. Boniface area is a desirable neighborhood?
Well, some parts of St. Boniface more desirable than others. So that this part in Uville is, besides older properties, so I think it's less desirable than other properties in St. Boniface.
But it is desirable, right? As like the neighborhood itself, it's a desirable neighborhood.
it's inferior to other parts in St. Boniface.
Okay. And would you agree that, like, because this is a low risk associated, because it's a new build, would you agree that there will be less capital expenditures in future?
No, it starts off with low repair and maintenance, and it goes up as it ages. The repair and maintenance goes up because now it's only $500 per suite, and so that if you're buying this now, you should expect that the repair and maintenance should be going up over time.
Okay. All right. Yeah, that will all be my questions, Mr. Chair. Thank you.
I thank you. Ms. McFadden?
I have no further questions. Thank you.
All right, Ms. Warhan?
Just to confirm how that you got the 1244, you took the city's NOI with your 5% cap rate?
Yes.
Okay, thank you. No more further questions.
All right. Either party wants summation?
No, Mr. Chair. Thank you.
No, thank you.
All right, we have heard all the items scheduled, and this hearing is now adjourned. So, gentlemen, thank you very kindly for your presentations, and results very soon.
Thank you very much.
Thank you
Thank
very much,
you.
everyone. Have a good
Okay,
day.
bye.
Thank you.